Hey. Hello. Welcome to Traders Talk. And this is Peng Hon, your host and one and only host for the Traders Talk. Okay, all right. Welcome on board. For those who have just joined us, this is a trading show. Okay, a trading show where we talk basically nothing but trading the stock market using options. Yeah. So if you are trying to learn options, this is a show for you to go out, come on board. And of course, we not only do trainings about basic option, and of course, today itself, we're actually also going to cover something a bit more advanced, yeah, something a bit more advanced because of the market volatility and of course because the market has actually rallied for Nasdaq almost about 18% up just in less than 2 months, right? Then of course there is a question by many people: should we actually take profit? Should we actually take profit right now and before the market actually crash? Because I won't say the market crash before the retracement actually comes back, because the market has actually retraced about 4 to 5% since hitting its high a couple of weeks ago. Yeah. And of course, right now, we are also uncertain whether the market is actually going to come down more, yeah, and or continue to actually go up. Of course, some people are actually also trying to ask questions whether they should actually hedge their positions, whether they should actually sell their positions. And of course, today, since we are actually talking about options, then we are actually going to guide you towards a technique where basically you can actually hedge your position almost practically free. Yeah, practically free. You can actually use options to actually hedge your position practically free. Okay, and of course later on towards the session, if you stay on long enough, then we'll actually go through that. Yeah. Okay, let's see. Okay, yeah. So let's cover some of the things on the market first. Where is the market right now, and where has it been? And of course, the most important golden question, right? Everybody is actually asking, where will the market go in the next days, or in the next weeks. Yeah, of course, I cannot tell you where it is going, because if I can actually tell you where it is going, then of course I will also be very how to say, very rich, right? If I can actually predict the market. Okay, let's just go through these technical things, right? Where is my screen? Gosh. Okay, I could not share the screen. Let me just check. Okay, yep, he's here. Okay, all right. If you can actually see the screen on the SPX chart, right? Just let me know. Maybe I will just make myself smaller. Yeah, the things are not. All right. Okay. So all right, that's better. I need to use my buttons to switch and toggle. Okay, all right, that's okay. So this is actually the S&P. I would say for the past 2 weeks, it had actually hardly moved. Yeah, although you can actually see that within last week, the prices for S&P has actually gone up, and then it comes down, or also in between days, right? You can see that it had a huge drop, and then basically towards the end of the market it went up, or the other way, right? So I would say last week towards the end, we had actually closed lower. We had actually closed lower. If you can actually see, where was it? You can actually see this bar candlestick, right, with a long wick, right? We had actually closed lower from Thursday, yeah. We because last week was actually February expiry, and of course February expiry tend to close negatively negatively, yeah, mainly because on options expiry days, right, most of the time people would need to actually adjust their position, and I would say based on history, February closing is most of the time is a red day, like, yeah. But of course, market also tried to push it up, and you can see that it actually recovered almost towards the end of the day, right? It actually recovered from the lows, yeah. So that's why even the same the day before, right? I think on Thursday itself, you can actually see the candles, right? Where it has actually also a long wick on the other side, means that the price has actually gone up during the day, and then when it closed, then it had a sell off. It had a sell off, and of course this not only happens one time during that trading day itself. It can actually happen a few rounds if you actually go to the lower time frame. uh, Normally I will actually look at the lower time frame, about 5 minutes time frame, right? You can actually see the intraday volatility of the days. Let's say, for example, this is Thursday, right? Thursday, you can actually see the prices actually went up, and of course, if you are long, right, then you will be actually happy. In fact, on Thursday itself, I had actually put in some long positions here. Then I went to sleep here. I went to sleep here. Very happy because all the positions are actually in profits, right? Yeah, because I had to put in some long hedge, because I also had some short positions which was in the money. Yeah. So in order to actually hedge the position when the price goes up, right, I actually need to buy some calls, right? So yeah, so the calls was making money, yeah. Although on the short side, we actually start to lose money, right? Then of course, after we went to sleep, right? After we went to sleep, what happened was that the market actually went the other way. When you went to sleep. So you go to sleep very happy, yeah. And then you wake up becoming a very sad person, yeah. And of course this is quite common, and if you see the next day, right, market open gapping down, and then towards the end of the day, it had actually gone back almost towards the price where it actually opened, the price which is actually open, yeah. So yeah, intraday volatility is actually quite high. Of course, there is good and bad, I mean, if you are actually holding on positions, then of course you can actually see your P&L, your profit and loss, one day up, one day down, one day up, one day down, one day up, one day down, yeah. So that's why even within the trading patterns which we have, right, although how to say, although the rather than seeing the P&L going up, going down, going up, going down, right? Sometimes also I take the opportunity to actually how to say, uh, go the reverse way of existing trade for a short-term trade. For example, if I have a short trade, basically a trade which let's say a bear call spread. Let's say, for example, I have a bear call spread, right? And of course, the bear call spread, you actually want the price to actually go down, right? Yeah. So for example, let's say we pick up a day here, a day here. Okay, so let's say, for example, at here, when the price actually goes down, right? Say, let me put this pen here. Okay, let's say the price actually goes down, right? So when the price goes down, your bear call spread would actually be in profit. Yeah, bear call spread would be in profit. Okay, so what happens is that, of course, then you actually see that it actually hits a support level, right? It actually hits a support level, and the bear call spread, sorry, the price actually bounce back and goes up. Yeah. So of course, when the price goes up, right, then basically the profits which you actually made from the bear call spread, right, would actually go away, right? I mean, how to say? Well, actually reduces, or you start to actually go into losses. Then of course, to so-called hedge the positions, right? Then of course you can actually, I mean, I can I put short-term trades to actually so-called buy a call, right? A cheap call, maybe a 14 days expiry, right? A short-term call, which is basically not too expensive, between maybe 200 to 300 dollars per call, right? I buy that, and then of course, when the price goes back up, the call actually goes into profit, and then basically the bear call spread would actually start to go into loss or reduce the profit. But basically the P&L, your P&L would actually be so-called neutral if the delta is neutral. But that means basically the profit which you made from this so-called down move would somewhat be protected, yeah. Then of course, when we get the call, right, then we buy the call would actually go up, right? And you see that the call actually starts to hits a resistance here. This is a support, right? This is a resistance, hits a resistance here. Then of course, that's the time where I sell the call. That means I close the call position and I take the profits on the call. And then of course, when the stock price comes back down, then how to say, the bear call spread would again go back into profits. Yeah. But of course, the difference which I had is I had actually hedged the position here during this time. I hedged the position, and of course, because I sold the call, I took some profits out of took some profits out of this trade, right? And I wait for again another round where the how to say, the price goes again. I can do another round, and then of course, if the price comes back down, then I might close the call position. So if you have a trade, you can do this multiple times, while waiting for the price to bounce around. Yeah, while waiting for the price to bounce around. Yeah. So this is actually a way to increase profitability of your trades. But of course, such kind of things you need to do so-called active trading, and looking at the screen, looking at the screen constantly, because these are actually short-term movements, which we are actually taking advantage of the ups and downs of the market. Yeah. So yeah, I mean, yeah. So that's some way for you to actually so-called hedge your positions by actually buying a call, or if you're the other way, you can actually do a put, right? Yeah. So that is one way to do it. Of course, there are many other ways. Later on, we will go through another way for you to actually do it, which is basically a way to actually not hedge for your so-called options trade, but hedge for your stock position. Later we'll actually go through that. Yeah. Okay. So come back to here. Okay. So this S&P, right? So come back to S&P. Okay. One day. I mean, for so-called beginners, I mean, don't trade that way, lah. I mean, the one which I actually mentioned would be for more advanced seasoned traders, right? They can actually do it that way. For beginners, please don't do it, because I think you will, how to say, you will you will be very scary lah. I mean, if you buy a call and then suddenly it goes the other way, right? You will start to panic and you do not know what to do. Is it? And if you message me in the middle of the night, I might be asleep and I can't help you. Yeah. So only for seasoned traders. Of course, if you want to try it on a dummy or trial account, you can actually try to actually learn how to actually manage trades that way. Yep. Okay. So yep. Okay. So this S&P. Okay. Green line. Recall this green line. Long-term resistance. Long-term resistance line. Which was actually breached. Which was actually breached here. Which was actually breached. And of course, what happened then till now, right? The price for this for the past 2 weeks, I think for the past 2 weeks, you can actually see that the prices has actually been trading in range. I would say around 4050 to maybe 4150. Yeah. So about $100 range here, it has actually been bouncing up and down, up and down, up and down within this range. Okay. So monitor this range. Yeah. Okay. Because when a price starts to actually do ranging, right? It is like it is so-called resting. Yeah. The stock is actually resting, and why it needs to actually rest is because it is undecided. It is undecided whether they want to go up or whether they actually want to go down. The stock is undecided. So this is S&P. I mean, it would actually be the same for any stocks, and it starts to actually range. Okay, so you can actually see other areas where it also starts to range. Yeah, you can see somewhere here it starts to range here. Yeah, it starts to range here, and then maybe you look for other areas where it ranges. Yeah. Maybe this is a bigger, no, this here smaller range here, it starts to range here. Yeah, there are many places like you can actually see, but of course this is a daily time frame. You can also go to lower time frame to see that it also ranges in lower time frame. This also can be considered a range. Yeah, this can be considered a range. Okay, so whenever they start to range, right, you need to actually pick the high and the lows of the range, the highs and the lows of the range. And as and when it starts to actually breach the range, right, it may be possible that it starts to break out from the range. It starts to actually break out from the range. Yeah. But of course, there may be a fake out. There may be a fake out. That if, for example, up here, right? I mean, if you see this candle here, you might say, oh, it starts to actually break out, but it needs to actually close above the range. Yeah, it needs to actually close above the range to consider that it has actually broken out of the range. And of course, if it combines with a bullish candle, if it breaks above the range, or a bearish candle, if it breaks below the range, then of course that is a higher indication that it wants to go that way. Yeah, it wants to actually go that way. So right now, as we see right now, last Friday itself, it seems that it has broken the range down. But of course, the candle actually closed back above the range. It closed back above the range. So I'm also uncertain whether this would actually go up or go down. Yeah. But having said that, then of course, what will actually influence this market or the stock price to actually move beyond the range? Sometimes it is actually also because of so-called news flows. And say SPX, what kind of news flows do we monitor for it to actually see where it actually wants to go? In fact, sometimes we also can't predict, because last week's news flows were all inflation sticky. But the market has actually gone up when those data were actually released. I think there was a couple of data which was released last week, right? So the market went the other way. Yeah. But of course, this week itself, I think monitor what will come on Thursday, right? On Thursday is basically the GDP data, 21st I think on Thursday. Yeah, yeah, GDP and employment claims. Okay, so GDP expected 2.9%. Okay, of course, if the GDP is below 2.9, then of course that is actually a negative economic news because their GDP is actually coming down, right? That means things are slowing, economy is getting worse. Then of course it is not good data. But the other way, if you look at it, then of course it is a data which the Fed would actually want to see being bad. Yeah, because if the economy is coming down, if the economy is actually coming down, then of course the likelihood of the achievement of it to raise rates to actually sizzle down the economy has been successful. So actually it can be both ways. Yeah, it can be both ways. It also depends on how the details of this data coming out. Sometimes they even go to the very intricate details of the so-called announcement to actually pinpoint whether it is actually good or bad, rather than just looking at the so-called percentage itself. Yeah. So of course, if you want to actually go deeper, then you have to really go and read the so-called full announcement on this. But of course, being a trader, I would not really go into reading all these kind of things because I am, how to say, I am not an analyst. I just basically look at the so-called price action of the stocks to see whether so-called that data which actually came out is bullish or bearish for the stock or the stock market. Yeah. Okay. So yeah, so we are actually here, and of course, I mean, not my prediction. I would say so far things have not been so great to actually favor towards the Fed's policy to start to reduce or cut the interest hikes. Yeah. Yeah, because the inflation is still sticky. And then what else? What other data? I think they released the producer price index. The thick prices are still going up, right? Still going up. Input cost is still high. So some of these things would make it how to say, make the tightening policy go longer. Yeah, go longer. In fact, because of these kind of things, you may not even see the rates to actually be reduced or cut this year. Yeah, reduce or cut this year. So March 22nd is the next rate hike, and then after that is actually May. Yeah, so far basically they are talking about these two. But of course, if the data is still not favorable, inflation is still high, then it may come to another hike, possibly another hike after May. So we are not sure. So all these kind of things you need to still continue to actually monitor on a so-called macro scale to actually understand where all these things are going. Yep. Okay. So yeah, so this is the current level. Of course, watch the zones. Yeah, if it actually breaks down, then of course highly likely it can actually come down very sharp. Yeah. And it is actually very difficult, and it takes a long time for it to go up, right? But if it actually comes down, right, it will actually come down very fast. Yeah. You don't even have enough time to react. Yeah, no time to react. Yeah. So that's why if you feel how to say, if you feel that you have enough taken some profits, you actually want to protect your profits, it is also a good time for you to take some form of hedge. You see, when it comes down, right, it comes down very fast. Yeah. So in a week, it can actually drop 200 points, and it needs to take more than 2 or 3 weeks, a month, right, to actually go up 200 points. And you can see that in a few a short time, this actually goes down like 300 or 400 points. You see, when it comes down very fast. Yeah, when it goes up, it goes up gradually. Okay. Okay, Nasdaq is more interesting, right? Because Nasdaq, you can actually see that the tech stocks had a rally since January, right? Most of the tech stocks had is rally, yeah. And of course, here itself, we are talking about 17 to 18% up to the tops here, right? And then again, it starts to actually do the ranging somewhere here, and of course, from 17 to 18%, it has actually dropped about minus 4% here. Okay, minus 4% here. Yeah. So, for example, if you have actually taken, let's say, a position on, say, QQQ right down here, you had 17% gains within less than 2 months. Yeah. So of course, 70% gains, you can actually, how to say, it's actually good gains, right? You can actually close shop and then wait for to trade another year, right? You can, because 17% gain a year, right? It's actually also quite good gains, yeah. But of course, if you are thinking whether this 17% can continue to go up, or you actually want to somehow so-called lock in your positions here, right? Lock in your so-called profits here. You're satisfied with 17%. And of course, if the market goes down, you do not want to actually give this 17% back, then of course you need to start to hedge your position. So how to do it, I'm going to show you shortly how to actually do it. Very cheap hedge, practically can be no cost, yeah. Okay, if you know how to structure it. Okay, so yeah, so this is one, right? I mean, this is actually on market. If you actually go on individual stocks, right? Let's say a very good example is this stock, yeah. Okay, a very good example is this stock. If you had a Microsoft stock, right? If you had Microsoft stock, right, you can actually see that Microsoft had a very strong rally this year, especially after this so-called Chat GPT thing came out, the AI thing, right? Came out, right? It had actually rallied about 26% this year. It had actually rallied about 26% this year. And from that 26%, right? And after they have shamed Google, right? After they have shamed Google, right? This 26% increase, right, came to about 17%. So basically, you're talking about having a position going up 26%, and then after that, basically the position actually came down by 9%, right? By 9%. So you have actually lost 9% from this so-called down move here, which 9% is actually a lot, right? It's actually a lot. Yeah, 9% from this down move here. Okay. Whether could you have actually avoided that drop? Could you have actually avoided that drop and protected yourself here? Yeah, because for me, my position on this stock, right? I mean, I have actually already. I mean, I did not do a hedge. I did not do a hedge, and I also tell you why. Yeah, I did not do a hedge. But I have actually cut sold off my position when it was actually at 274. Yeah, I have also written in our newsletter to say that I have actually sold off my Microsoft position at 274, mainly because of this how to say, the rise here. I felt that it is actually too much, too big, too fast. Yeah, so I think that highly likely it would actually have some retracement coming, and as a result, I actually took my positions off here. Okay, but of course, if you do not want to take your positions off, you can actually do a hedge. Okay, but the technique which I'm going to teach you how to actually hedge this, right? One caveat is that you need to actually have 100 shares. Okay, only do this if you have 100 shares. If you do not have 100 shares, don't do this. Why? Because I'm actually using options to actually structure out a hedge. And of course, if you know options, right, one options represents a control over 100 shares. Yeah. So if you don't have 100 shares, you can't use this technique. And also because my Microsoft position, I also did not have 100 shares, right? So I could not use this technique to actually hedge my Microsoft position, and instead of how to say hedging it with options, what I did was I sold the position off. I sold it. I totally sold it, and then after that, when the price retraced, right? When the price retraced, I sold a put. I sold a put. Yeah. So what happens is I use options that way in another form. Because I did not have 100 shares, I have to use another way to actually so-called hedge my position, and yet still have some form of interest in Microsoft. Because when I sold my position, I would have no interest in Microsoft, right? But when I sold my position, I took profit out at 274, yeah. And then later on, when the price retraced a bit, I sold a put. When I sell a put, basically I means that I actually have interest in taking up 100 shares in Microsoft, right? And I collect premium here. And of course, if the price goes below the put, then of course I can actually how to say buy the put, take over the put. So what I have actually benefited is that I have bought back Microsoft at a lower price. Say for example, I sold a put at say 270, for example. Okay, I sold a put at 270. What it means that I sold the stock at 274. Okay, and then I sold a put at 270. So basically, if I did not do anything, right, when the price drops to 270, I would have lost $400. Yeah, $4 here. Yeah. But of course, if I have sold the position, and then after that I sold a put at lower price, and the price really drops, then what I did was I have actually so-called made $4 here. Yeah, from not losing $4 in my stock position. Plus, I will take additional premium coming out from selling of this put. Say for example, I actually sold the put for $4. Yeah. So basically, I would have actually got this so-called $8 if I did this, comparing to how to say, comparing to just losing money by not taking action using options. Yeah. So this is another form of way how you can actually do this. Yeah. And you can do this even though if you do not have 100 shares, because it's okay to actually go this structure if you do not have 100 shares. But of course, if you do this, then you need to be ready to actually collect or buy 100 shares if it actually goes in the money. Yeah. So this is one way for you to actually so-called hedge your positions. Yeah. So this is one way. Okay. Okay. So then we go to the other way how you actually do it. Yeah. Let me just stop this. Yeah. Let me go to the other way. Only if you have 100 shares, you can actually do this. Yeah. Did I share my screen? I think I did. No. No. No, I didn't share. Okay. Okay, I hope you can actually see this right now. Okay. So what this is, okay, so say for example, on the example just now on Microsoft, okay, Microsoft is actually now trading at 258, okay, 258. Okay, and just now you actually saw that the price actually came down, right? Okay, So of course, the best time for you to actually do this is when it is at its high, yeah? When it hits its so-called resistance. This is the best way to do it. When it is actually overbought, this is the best way to actually do a hedge. And when you actually do a hedge, don't do a hedge when the price starts to come down. You need to do a hedge before the price actually starts to come down. Otherwise, if it goes down already and then you start to do a hedge, it will be too late, right? Because you would have already lost in this so-called down move level. You would have already lost it. Okay. So, but anyway, just for education purposes, assuming that now Microsoft hits a so-called resistance at 258, yeah, at 258. Okay, hits the resistance, and you feel all right. I think Microsoft is overbought and it might actually come down. Okay, and you have 100 shares of Microsoft. You want to hedge your long term position. Okay, so this is 258. So what you can actually do is, okay, normally when we have 100 shares, right, one of the ways for us to actually earn more premium, right, is actually to do a covered call, right? You guys know covered call, right? Covered call is basically selling a call when you actually have 100 shares, and when you sell the call, you basically sell the call above the current price, yeah. Okay, so yeah, above the current price. So for example, if you actually go through the options chain, I won't go through that. If you actually run through that and maybe you put April expiry, like 69 days, and you look for a price of say 270, right? You actually want to sell a call at 270, which is basically $12 above the current level. Yeah, because if you sell a call and if the call goes out the money, you actually get the premium, right? And if you sell this, if you go to the options chain today, you see that you can actually collect $720, $7.20, which is $720. So basically, if Microsoft share price closes on expiry, right? Say at this level, maybe 268, right? Then of course you collect this 720, everything you collect it. So what you make is 258. Let's say this is 268, right? Okay, you make $10 from the share price increase, plus you make another 720. Okay, 720. So basically you have actually increased your profit from 278, you plus 1720. So this is five, this is how much, five, 6, 7. My math's very bad. Yeah, so instead of just having the stop price at 268, your position would have been like going already up to $275.20. Yeah, which is 720 above the price here. Okay, so you have actually already made how to say better. But of course, what happened is that we are not expecting the price to go up, correct? We are expecting the price to actually go down. So a covered call won't really protect this position here. Won't really protect this position here. Okay, let me rub this. A covered call won't protect your position of this 258. It won't protect, because if the price goes down, right, what will happen is that 258, then of course your protection is 720 lah, correct? Because you already upfront collected so basically your protection is in the upfront premium which you have actually got, then it's 258 minus 720. Then of course, even if the price goes down here by minus 720, right? Yeah, your so-called value of Microsoft 100 Microsoft shares will still be $258 because you have collected that 720. So your protection to the downside is limited to whatever premium you collected here. So that is your protection. Of course, if you want more protection, what you can actually do is to do additional options. Yeah, 270 here, right? Okay, what you can actually do is you go to the second step here, is to actually buy a put. Okay, because you know, if you buy a put, right, what happens is that when stock price goes down, the put goes into profit. The put goes into profit. So you buy a put, same expiry date, you buy a put. And at what strike price you buy a put? Very simple. You have actually collected 720 from this you have already collected 720 from this call which you sold. Okay, so what you can do is you use this 720 to actually finance a put. Yeah, we call it financing. I mean, financing, getting things for free. Yeah, and of course, if I run through the options chain, right, I could not get exactly 720. Anything, any strike price, I couldn't get 720. I can actually get how to say, I can actually get below 720, but of course the lower, if it is below 720, then of course how to say, the strike price would actually be not be 250 anymore, right? 250. Okay, it will be a different strike price. Okay, so what I do is I do the closes lah. So when I go to closes, I saw, okay, 250, I can actually do a put at 250. Okay, I can use this to finance a put at 250, and because that put value is the 780, I need to actually pay 60 cents. I need to actually pay 60 cents for this hedge. Okay, 60 cents. I mean, practically 60 cents is more or less like free lah. I mean, it's you have 100 share in Microsoft ma. Microsoft drop 60 cents can in seconds. Microsoft can drop 60 cents in seconds, right? Yeah. So 60 cents is basically nothing. If you actually want to protect your 100 shares here, okay. So you take 60 cents to actually hedge it this way. You sell a call and you use the premium collected to buy a put. Okay. So what happens is, of course, if Microsoft shares goes down, right? Microsoft shares goes down, your covered call here would actually decay in value lah, which means that you make money lah. Yeah, your covered call here, if it goes down, it goes more out of money, right? You make money. Okay, so this covered call, you can cash in, you can make money here. Okay, and of course, when you buy a put on that day, right, and if the price goes down again, this put will also make you money. Will make you money. Okay, will make you money. Okay, so the call will make money, the put will make money. So where do you lose money? Where do you lose money? Of course, you lose money from these 100 shares which you have. Okay, you lose money in these 100 shares which you have. So when you actually lose money in these 100 shares which you have, these two positions which you are actually making money, right, will actually protect your how to say, your 100 shares here. Yeah, the level where it protects depends on how long you have actually held these options hedge which you have. Yeah, of course, the longer which you have actually held it, the if it goes the other way, then of course this would be better. But of course, on the put side, then there would actually be decay in the option value, decay in the option value. Yeah, decay in the option value, which might offset a bit of the profits which you actually make when the price actually goes down. Okay, so yeah, so this is actually a hedge. You paid 60 cents, but when you pay 60 cents, basically more or less, I would say your stock price, your stock, that means your stock value of $258 or $25,800 would more or less be intact around that level, yeah. So even if it goes down, you don't need to be worried so much if it actually goes down. Yeah, and because even if it goes down below 250, right, your so-called max lowest price of your so-called loss, right? Loss is actually 250. It will be actually capped at 250. Yeah, that means it will be capped lah. But of course, the if this option still have is still not expired yet, right? Then of course you would actually make some profits if out of the put, and this would actually be a so-called full gain of $720. Yeah, which will basically be the first level of protection. Remember just now, when you do a thing, when you do that, you have a first level of protection up to $250 and $250.80. Yeah, $250.80. This would actually protect you. Okay, and of course the profits which you obtain from this put, right, will even protect you further. Yeah, will even protect you further if it actually goes here. But of course, if it expires, right, then this is actually the already 250 and 8 is already the max protection which you actually get. Yeah, but of course you play around in the so-called price action of Microsoft. You need not hold this till expiry. You need not hold this till expiry. Yeah, because the stock price, right? Let me add this. Okay, because the stock price, right, will actually move up and down, right? Will actually move up and down. Say just now Microsoft was actually shooting up here very fast, right? Then now it has actually retraced. Say for example, you have actually done a hedge here with the structure which I just taught you just now, right? You have actually done a hedge here. Okay, so when it is actually coming down here, right? Then of course, just now that two positions, the short call and the long put, right? The long put, you will actually make money, right? So when it actually comes down here, you're actually making money, yeah, protecting your 258 Microsoft share price here, right? Protecting it. It was actually protecting it. But you make money here. You make few $100s here. Okay, so you make few $100s here, and it's actually coming down. So the protection is intact now. Okay, but as you see the price action, right? Maybe it goes sideways like that and starts to actually goes up again. You cut this position. You close this position. Okay, so you close this position. Basically, what it means is you take profit. You take profit. Yeah, you take profit. So you take profit in this position, and then of course, because you don't need a hedge anymore, it's not going down anymore. Why do you need this? Correct. Don't hold it forever, right? So you hold it when you need it, and when you don't need it, you actually cut it off. Yeah. So that's the time where you take profit on this, and of course, this was actually hedge plus this profit, right? This was hedge, right? So when the price actually goes up, right, then basically again, what happens is that you are actually enjoying the upside from this level up again, this level up, not here, So you don't need to wait for Microsoft to be above 258 to enjoy. If you have done this, you will actually start to enjoy this right up, right down, right from here itself. Okay, if you have done this. So this is ways and techniques which you can actually use in options to actually play around to actually protect your positions, especially if you have how to say, long-term positions. If you don't do anything, right, at the end of the day, what will happen is that the stock price will go down. The stock price will go down. I mean, remember Microsoft went to $330 all the way high, right? $330, and now it's 258, right? Before that, it was even lower. It went to $210 or something. You see, if you don't do anything, if you had 100 shares back then, right? 100 shares back then, you would have actually taken all this hit all the way down by almost $100, right? You have actually taken, but if you have use options to protect positions in the right way, then of course all this would not happen, and of course you would actually start again to ride the upside, maybe all the way right down from 210. Yeah, that means here you, when it comes down, you make money. You don't have to worry that the price going down by 30%. And then when the price goes up, right, yeah, even if you did not buy any additional Microsoft shares, right, you would have already ride the so-called how to say, the retracement back up, right? You have already ride it again to make profit, yeah, rather than just sitting on doing nothing with your 100 shares. So guys, if you have 100 shares lying around in your account, right, yeah, do learn how to actually use options to protect your 100 positions. And it's also very important if you understand this, because once you actually understand this, right, I mean, you would not really, how to say, you will not really so-called diversify your position, buy 10 shares here, 10 shares here, 10 shares here, 10 shares here. At the end of the day, you will never be able to protect yourself in it, rather than just how to say, using another structure to protect. I mean, you can use SPY to protect, but basically that's another kind of hedge. But you will not be able to actually protect. But of course, if you already gathered and over time accumulate your investments, right, to try to reach 100 shares, right, and when you have that, that becomes very powerful for you, because you have a lot of ways to actually make money out of these 100 shares. Yep, you can sell covered call if you want, and you can actually do a lot of things with these 100 shares. Yeah, so try, when prices comes down, retraces, try to actually accumulate your positions to get these 100 shares. And once you have that, it is actually a very powerful money making tool for you. Yeah. Of course, there are other option structure where you don't need even 100 shares. You can how to say, you can do some form of synthetics or what to do, but that's that's another, like another another strategy to do like. Yeah. Okay, so this is this is basically what I wanted to share with. I hope you guys understand this. Yeah, I hope you guys actually understand what I tried to share, because really this is actually advanced options strategy. Okay, I mean, yeah, this is really advanced. I mean, I'm not really teaching you so-called basic stuff here. I'm not teaching you basic stuff here. Of course, if you follow us, if you go through our newsletter, and that's that's where you can actually pick all these things out, little advanced stuff. Advanced, people pay thousands of dollars to actually learn this, and I do it free for you guys on our channel. Yep. So yeah, I mean, keep the learning process continuing, keep the learning process continuing, and of course, learning never stops, right? Yeah, if you can actually learn something new every day, that will really help you grow long term. Okay. Yeah. Did it stop somewhere? Okay. All right. Yeah. So yeah, I mean, let's see where the market is actually going today. Of course, the market is I think down, slightly down today. Yeah, yesterday there was no market, right? So very relaxed day. Yeah, market is down 135 points for Nasdaq. Yeah, futures, and today S&P is also down by 34 points. Yeah, so that's why watch the range. Yeah, watch the range. Yeah, I think it will likely break the lower range, and do some form of retracements back to the resistance line, and basically 4050 would actually be the first level. 4050. Yeah, let me just check. Let's go back to the chart for a while before I end the show. Something wrong with my PC, is been a bit laggy. Okay, so it's actually coming down, and I would say maybe at this level, right? Watch this level, it actually comes down, right? This level here, which is basically about 4,000. Yeah. Yeah. So the first level here, 4,000. If it actually breaks, right, then of course, this would probably form a support line. Yeah, this will actually form a support line before going down to lower levels. Yeah. Okay, so happy trading this week, and yeah, don't forget to subscribe to our newsletter. I've gave out some again very advanced advanced option strategy, which is also something which have actually covered just now earlier on the first method of uh, day hedge on your positions. Yeah. Yeah. Okay, so yeah, if you have any questions, do go on our Facebook, post it there, email me, yeah, comment on our Substack, yeah, on our Substack magazine. Where's our Substack? Let me see if I have the Substack here. Yep, here, yeah. So this is the Substack. Let me copy this to the chat. Okay, Substack. So this is our magazine. We issued our 101 101 issue this week. Yeah, I mean it's 101 issue. Yeah, so if you want to read, there are basically plenty of stuff for you to actually read on the back issues. A lot of learning, and of course, like I said, learning never stop. If you find 10 minutes a day to read my newsletter, you will probably finish it only in 3 months. 3 months time. Okay. So until then, catch up with you guys. Happy trading. Have a safe trading week. Bye bye.